Good morning. This is Lane Jones, Chief Investment Officer at Evensky and Katz Financial. Today, not surprisingly, we'll be talking about COVID-19, coronavirus, and the market implications and strategy and how we are chatting and advising clients. Starting right off the bat here, let's talk about what's going on. I think it's important that you acknowledge, or that we acknowledge, that we don't know anything more about coronavirus than anyone else. It's a good place to start and to understand the limits of your ability to evaluate and analyze a particular situation as applies to investments. You can make some assumptions and educated guesses. You can obviously read quite a bit from a lot of smart people, but the short version is there's lots of unanswerable questions. And I think it's important to sort of start with that as you frame how you invest or any changes you might make. I think probably the most important thing I could say in the entire talk is that the single biggest driver of these declines is the economic uncertainty. How long is the impact? How severe is it? And then how many dominoes might trip over that you don't see coming? The stock market is used to evaluating its own certain metrics, payrolls, GDP growth, profits, earnings, and projecting out into the future what it thinks the likely economic scenario is and how profitable ultimately the global economy will be. The challenge here is that with a pandemic, the ability to do that with any measure of certainty is really, really, really difficult, and therefore it is very, very, very difficult to know how to rationally price securities in that market. And you begin to see a market that is driven by a fear trade or just really operating on a lack of concrete information and abilities and the traditional tools we would use to evaluate stock prices. I think another important thing to acknowledge is that, especially in the last 3 or 4 trading sessions, that liquidity is at a premium. And when you see all these things that the Fed are doing, clearly some of them are trying to backstop the economy, but a good amount of them are trying to be mindful of some of the dominoes that tripped over in the financial crisis and prevent liquidity from seizing up in the market. We're seeing the last 3 or 4 days kind of an unusual result that is bonds, other than treasury bonds, are actually selling down a little bit. And you'd say, why is that? People are leaving the stock market and buying bonds. Well, it's because people are just raising cash, and some of it perhaps is indiscriminate selling, just say sell everything. Other folks are just saying, look, I want to be in the highest quality security there is, the U.S. Treasury, and that or keep more cash. And so you're seeing some pressure in the bond market as just everybody tries. Liquidity is about everybody trying to fit through a door at one time, and it just gets very crowded. And that's when prices start to move away from intrinsic value. I would acknowledge what's going on. Markets can certainly get worse before they get better. Ultimately, this is driven by sort of a non-economic driver, right? Catalyst, a global pandemic. It certainly has implications in the economy, and that's what we're all trying to sort of sort through and figure out, aside from obviously the human and health aspects. But there's no question that I don't think we're out of the woods. I think that realization really started to come up just in the last week as people, we started to kind of get our ducks in a row in terms of how we're going to handle this thing, whereas previously maybe we were hoping that it wouldn't break containment in China or all these various things. So it can certainly get worse before it get better. I would not try to fool anybody on that. I do have some pretty strong opinions on that. You just have to be in markets and ride through it. But the last point, what's going on, I would tell you it's different than 2008, 2009. And this sort of leads back to what I just said, which is, 08, 09 was driven by a financial crisis. And that financial crisis was ultimately, no bad pun intended here, driven by sort of a toxic or viral asset that was in the system, a bunch of bad mortgages and overpriced houses. And that ultimately infected a banking system, and that had spillover effects all over the world, the global economy. The thing that is clearly different here is that we had a rather strong economy coming into this, if not super strong, but at least clearly growing. And what we know is that the economic impacts, I shouldn't say no, but what we believe is that the economic impacts should clearly be temporary, which is that when the thing passes, not only will life hopefully get back to some semblance of normal, if not, maybe not exactly the same, but similar, and that there should be this overwhelming demand that's been sitting on the sidelines that will come flooding in and sort of pop economic growth back. So it is different than 08, 09. You know, the end results in terms of investment markets feels clearly just as scary, but it is a different underlying economic condition. I want to sort of talk a little bit about where going back to this uncertainty driving things. The composition of market participants, right? This is the way it always is, and today is no different. 10 years ago, it was the same way, maybe a little bit less. But there are three basic groups that I have in markets. There are the fundamental investors, people that sit down, estimate future profits, and they vote on the price of any security by whether they buy it, whether they sell it. And this is the efficient market that's out there that every day people are voting on how much, what they think security should be worth, and that ultimately that's the best consensus estimate on things. And new information obviously changes that. This is your Benjamin Graham. This is your Warren Buffett. You know, that sits around, and this is what we all like to think the investment world. People, you know, sort of thoughtfully with their pencil sharpened to calculators, calculating out what they believe a price of security should be. But there's two other major people in markets or things in markets that you have to be aware of. Some of it is a little bit more new than maybe 30, 40 years ago, but nonetheless, they're still both here. There are these behavioral driven fear and greed elements to markets, which is they're not evaluating underlying economics. They're driven by the herd, and not only the pain of losses, which is what we're seeing now, the fear, but also the FOMO, the fear of missing out on the other side, the greed, right? You know, the dot-com bubble is a classic example of this. I call this the error term, the E, which is if we spend all our time up here in the fundamental investor side evaluating, well, I think the beta of the stock and the future earnings prospects are this, and interest rates are that, I think that the stock is worth this, right? Some number, you know, $50 a share or $20 a share, whatever it is. And then there's always some reason why it's not exactly at that price. And it's because there are people that are just driven by momentum and fear and greed, and they sort of move prices away from maybe their, what we call intrinsic value as determined by fundamental investors. There's then this third group in here. It's probably more recent. They've always been around, but they're certainly more loud than they used to be. And that is the short-term speculators, or what I call traders. And these folks are really just focusing on momentum on a daily basis. Maybe they might carry some risk overnight. And I always describe it as sort of trying to pick up nickels, which is they're just sort of hopping on a trend, trying to pick up a little bit of money here and there. These days, they greatly exaggerate the daily market moves out there, and they do so really without any new fundamental economic information. They might pick up a direction or a headline. You know, jobs number comes in great, then they hop on a long trade. If it comes in poor, they hop on a short trade. I group these two people together because I think they are driving the market right now, because there's a real inability to do the mechanics of what a fundamental investor does, which is estimate future profits, because there is just so much uncertainty around it. And this is what's driving the market. The fear and greed or clearly not the greed, but the fear is driving the market. And then you have it exaggerated by these people hopping on the momentum. This is why, at the end of the day, like we saw at the end of this past Friday, we saw the market just scream higher. It's probably because there was a lot of short covering at the end of the day where people didn't want to have risk on over the weekend. And they were just covering their books. It had been a really, really bad week. They were shorting stocks, trying to make a little money, and then all of a sudden everybody has to take off that short position, so they went as buyers in the market, and that pushes the markets up. This is the computers and the trading algorithms at the end of the day. So these aren't just humans that are just trying to sit in there drinking coffee at your day trading stand in the local strip mall. This is institutional investors and big computer algorithms too. But lesson here is that the market is normally driven fundamentally here. This is the long-term how the market is driven. Profits. This is the short-term noise and gut-wrenching roller coaster that we're driving today. Let's talk a little bit about the Fed and the government response, sort of in this theme of what's going on. Well, we know overnight, last night, Sunday, they cut interest rates to zero. They had cut 50 basis points, I want to say a week and a half ago or so. They had a meeting in about later on this week where they could have done this, but they decided they needed the sort of out of the financial crisis, the old Sunday night special, and they cut rates to zero overnight. So we went from about 150, 175 all the way to zero, like in the snap of a finger. And They also did another program. They initiated quantitative easing 4. We haven't seen a QE for some time. These were the first QEs, with what we saw in the financial crisis as tools to try to spur the economy. They committed to buy $700 billion in bonds, $500 billion of it is treasuries, $200 billion mortgages, because in a nutshell, they're really trying to take what I call a nuclear missile, an ICBM, and smash down on any semblance of a repeat of the crisis, where we had banks seizing up, where we had liquidity being ground out of markets, and that created a whole other host of problems, right? Financial crisis was about an overpriced real estate market. It should not have necessarily had this massive spillover into the global economy, but it did in part because of liquidity problems. And they are really, really doing their best to absolutely say, we are not going to have it. They're hitting this with a sledgehammer. And this is on top of what they did last night, of what they did last week, where they pledged $1.5 trillion to overnight repo markets. That's a lot more money than sounds like a lot more money than actually is. These are like overnight loans, so they're agreeing to lend $500 billion overnight, and then another $500 billion perhaps for 2 days. And I think the other last 500 was for 30 days. So this is just making sure that overnight everybody's got money. Nobody's afraid that somebody's going to be broke the next day, and that there's massive amounts of liquidity injected in the system. These are I don't know about Fed cutting the rates to zero overnight as a smart move. I don't think it really in practice does much, but they're clearly trying to put logs on the fire in advance and make sure that there's liquidity in the system. So I do think these are good things, even if Chairman Powell has been criticized as being a little too panicky in the way he has addressed the market. And you see it every time he cuts rates, the market actually sells off. It just seems like there's a little bit of disorganization, or he's a little panicky in the way he presents it. In particular, they had a meeting in a few days. They could have done this in a few days, but like I said, they wanted a Sunday special. I will say this on the government response. Unquestionably, what we really need is for Congress to add a financial backstop via what we call fixed fiscal response. That's the tax side, either tax cuts or spending side. We've talked about payroll taxes. They've talked about suspending the student loan payments. They've talked about a lot of different things. And on a whole, this is what would I think need to happen. And it has to be a bazooka. It's got to be a $500 billion or so. I'm just throwing numbers out there. Big response in order to really make the small business people, the corporate America, feel like, all right, the public sector is stepping in when the private sector is getting squeezed, and it's clearly getting squeezed. Why? Because we didn't really talk about this. The economics of it all that are just falling off a cliff. The prospects of everybody staying home and not doing anything for 2 or 3 months, is a pretty big slap at the economy. You can see here, this is just the fiscal responses in other countries, right? And this is as a percent of GDP. Hong Kong took a real sledgehammer here, 4% of GDP. U.S. has yet to do anything, even if I think this is lining up to happen. And then you've got various other places. South Korea, Italy has already sort of seen this. You can see it in Asia, where some of this stuff's been a little bit more pronounced. So it would not surprise me if we don't come in with a pretty decent fiscal response. And it will have to be significant, in my opinion. The market will shrug off if it's sort of half in, half out. And I think it will be important to really, really come in strong. Let's talk a little bit about valuation. What's going on? Well, all right. Well, this is the stock market run from 11 years, March of 2009, all the way into here. You can see we started, this is the price earnings ratio at about 18 times earnings, and we've now fallen down to about 14 times earnings. This is the decline of, this is just as of Thursday. Interestingly, Friday was an up day, but Monday is looking like a pretty bad down day. So I think this actually will come in pretty close to where we are. You can see, lots of fits and starts in an expansion. It's why you can't time the market and say, oh, let's get out here, because it quickly reverts right in your face and goes straight up. This was, this was December of 18 when the market fell 20%, another in 3 months. I would say this is now approaching probably 30% on the world stock market, which is obviously a really, really nasty decline when you figure that it's been in just roughly 3 weeks' time. Think about valuation on the market. The forward PE, and forward is important, we'll talk about, but the price earnings, this is the price of the stock market over the profits of the stock market. So this is a measure of how expensive or cheap the market is. And the 25-year average price earnings multiple has been about 16.3 times. We were sitting up here at 18 to 19 times, and wow, all of a sudden we find ourselves at 14 times. This would suggest, hey, sell up here, buy up here, right? Markets can get really out of whack like they did in the dot-com bubble. They can keep going, or they can keep falling, so you don't buy too early. But the thinking here, and what I want to sort of point out is maybe even just the problem with using a traditional measure like a price earnings multiple. The P we know, the price of the market is determined every day out there. You can go look at the S&P and see what it's trading at. The E is the earnings on the market, the profits on the market. And right now this is why it's called forward, in this 14 times number, there's an assumption that earnings are growing anywhere between 7 and 10% on the year. Now that's pretty clearly not going to happen given what just took place or what is looking like it's taking place. And so the E part of this could be substantively lower. And what happens if we reduce the E? The PE is going to go up. Just running some rough math on this, if you looked at the markets being flat, if earnings just didn't grow at 7 to 10%, but rather they grew at 0%, they were just flat. That takes this number from about 14 times to 15 times. So still a little under the long-term average. If you go into a recession, and the recession is, on average, earnings decline somewhere between 10 and 15% in a recession. If you do that math and you reduce the E, not only by the 7% it was supposed to grow, but now you take it down another 15%, it takes this number up to about 17 times earnings. So a little rich, but not out here, right? This is dot-com bubble crashing. Not even where we were before, right? 19 times almost. I would tell you that it is maybe almost what I'm trying to get across is that it is very difficult to use a price earnings ratio to evaluate in a real swift change in circumstances how the market is being priced. If anything, it just shows you how it's an unknown. I can give you an example that the price earnings ratio in the financial crisis at the bottom of the market was really, really high. It would tell you don't buy stock. This is really, really high. And it's because the earnings had collapsed. Well, earnings don't stay down forever. They eventually come back, but the ratio would just be a little bit misleading. Either way, I think it's important to sort of see how it's waffled in between, expensive and sort of relatively cheap by most standards. This is one standard deviation. Moving along, what's going on? The economy obviously is expected to take a big hit. This was China's manufacturing and service business, and this is the financial crisis. Above 50 means you're expanding. Below 50 means you're contracting. I don't know that I paid too much attention to this, but you've got services here in manufacturing, and what you see is that this is what just happened. And if this is any indication about what's happening there, it's probably a pretty good indication of what's going to happen here, which is that it is going to be a severe, severe slowdown in the economy. The magic question, obviously, is how temporary is it? And when we talk about being temporary, there are some things that we can look at that maybe will give us some hope. One of the things I'll look at is let's just quickly look at the timeline of COVID. Now, this is a little graph everybody might remember from the Johns Hopkins dashboard. And while I will say the Asia timeline is absolutely imperfect, it's all we've got. And maybe I use this to demonstrate what I think you would be looking for. This is probably the only thing I'll actually talk about on the actual virus itself, because you all know just as much about it as I do. But what we can see in here is that this is China's growth rate, and this is all other countries. So it clearly happens there first, and then catches up here. You don't worry about the green line. That's people that sort of have recovered. And what we'll see is that there's this exponential growth up here, and what you're really looking for is when does this rate of increase start to flatten out? And this means you're starting to win, right? New cases are slowing. They're not at this sort of, exponential growth rate. I would say right in here is January 24th. This is right when they shut everything down. They said, all right, 60 million people, Wuhan, we're not going anywhere. Then they expanded to 100 million people. And by the time you got to right here, it was about 3 weeks. This is about February 11th, maybe Valentine's Day, when you started to see the first signs that this was plateauing in China. Doesn't mean everybody was getting healthy. Clearly, people are still dying. But it was the first sign that, all right, the containment efforts that started here were starting to work, and we were seeing progress about 3 weeks later. Now, you go out to right about here. This is the rest of the world humming along, and us, everybody sort of breathing like, wow, that looks like they got this. And all of a sudden, over the weekend, February, I want to say 19th or so, maybe a little bit earlier than that, it breaks containment in China, which is clearly should have probably been obvious to everybody in retrospect, but that's hindsight. And Italy, South Korea, Iran, all showing symptoms. It starts to show up in the United States. And we wait, not surprisingly, about another, if you think about when they started their containment with the 24th, it kind of first surfaced about 2 to 3 weeks earlier. We wait about 2 to 3 weeks, and it seems like this weekend really is when, things started to really get sorted out. Like, all right, we got to turn our containment. So you got to expect, this is, amateur virologist Lane Jones here, saying that you got at least another 2 to 3 weeks before you get a flattening out in this curve of new cases around the world. And obviously there's a lot of variables in that, some of which are not necessarily on our side. The two that I would worry about is that the Asians have a lot of experience with these types of things. You can look at Hong Kong. Hong Kong's a fantastic example. They really knew how to handle this. And so they maybe got it turned faster than the rest of the world were. And then the other thing is that, this was when the epicenter was in one place. Out here, the virus is coming from all directions into all places, and everybody handles it differently. So, it's hard to predict. I think this would probably be best case scenario, right? 2 to 3 weeks before we get a rate of descent in this. I think it's clearly a few quarters of economic damage because, already we're talking about, going into summertime with things protracted slowdowns and events canceled and the like. When I spoke earlier about, well, what's the positive here, right? This is 20 days after the Chinese New Year. This is about 3 weeks after they shut things down in terms of like trying to prohibit travel, and right about the time that it started to turn. Well, you could see the usage of or the historical average of these economic indicators. It was at 40% of this level. A month later, all these numbers had increased. Right, some really, really quickly. This shows how fast this can turn around. Now, granted, this is a period of a month to 2 months, but it does show that this isn't necessarily something that lasts for a year. Again, a lot of things are dependent upon that, including the response of everybody collectively. So I would see this as good news. This is an example of how things can turn quickly to the positive once you sort of cross that threshold to flattening out. What to do? This will seem like the broken record for our clients because it is much like the playbook from the financial crisis. You hear the story. History is unique, but not different. This is, don't panic. We really, really anchor to our investment discipline in times of crisis, and that's why we build it in advance and why we put a lot of fat of it into advance. I would tell you that in this market, liquidity is king, which is having enough cash reserves, having enough liquid assets, not being too stretched in esoteric things. That doesn't mean the stock market. I'm just talking about bond. You can have some bonds. Make sure you have some high quality bonds, that you have enough adequate cash. One of the things we are talking about doing is the possible sale of some of our fixed income just to raise cash. We did that in the financial crisis as well. Rebalance to buy modest amounts of money into stocks. This will help with the recovery. If you don't believe that the economy is just flat out going to end, and you do buy that there is generally markets do recover, then buying when markets are cheaper just helps you recover faster when that market turns. I would say another thing is avoid selling equities. If you need to raise money, try to avoid selling stocks down here. That's sort of the one mistake investors can make, is sort of being forced to sell at the wrong time. If you need liquidity, on an ongoing basis, try to tap it from your bond portfolios. this is a big part of the cash reserve strategy we run, which is that every portfolio not only has cash reserves that they need, they also generally have a fixed income buffer that we can tap into if we get into a prolonged downturn, so we're not forced to sell stock. Now, if you do want to make any changes to your policy or your investment strategy, I would say do them in concert with a look at your planning. If you sell stock down here, you probably have a lower expected return going forward, and maybe that compromises your standard of living, or maybe it doesn't. Maybe you've got enough room in there that you could afford, maybe tighten it up a little bit. But I just make sure you make any changes in concert with you and your planning. I think, you do start to also look for opportunities. We have our satellite equity sleeve in some portfolios where we'll look to sort of do some modest opportunistic purchasing. And then there's always the tax trading loss harvesting, which is just try to bank losses that are present. You don't ask for them, but while they're there, you go get them and you use them to offset sort of taxes that maybe come up this year or in future years. Move a little bit to the Q&A side of things. We have, there's a question, sort of rather than asking people for questions, we've gotten talked with enough folks lately that we know sort of one of the common questions are out there. And I'll start right with the really sort of common one, which is, why shouldn't I get out? It's obvious that it's going lower. I would say, looking back clearly, with perfect hindsight, I can understand why people would ask this question. I thought it was going lower before, and we didn't do anything. I think, there's a lot of hindsight bias in there. I think the challenge is that we have to acknowledge we don't know what's going to happen. It might feel like, clearly the trend is negative and going down, but markets move very quickly the other way. You can even see it, in some of the days we've had up 2,000, down, not quite 2,000, up 1,900, down 2,000. It's clearly been more down than up. I mean, that's obviously why we have a world stock market down in the range of 25-30%. I would point out this slide. This one is an old one. Market timing is effectively what we're talking about here when we ask this question. Let's get out now and we'll be able to get in lower later. The market timing, stats are well known, and this is not terribly recent. This is a 10-year window, some time ago. But on the whole, if you remained invested for the entire period, you made 88%. If you missed the 10 best days, that number, that return, just missing 10 days out of a 10-year window, your returns fell to 16%. That's a decline of 62%. That's not a great period of time for 10 years. And then if you missed 20 best days, you lost over 100% of return, and you actually wound up with a negative period of return. Most people are pretty smart in saying, well, what on earth would be the odds of me missing 10 best days or 20 best days? I'd have to be the worst luck investor on the planet. But what I think the lesson here is in these bottom phrases and statistics, which is that the best days occurred within 2 weeks of a worst day, 70% of them. Right? So that means when all these terrible things are happening and when it is obvious that it is going lower, you get smashed with some good days that make up a lot of the return. And they're in close proximity, 2 weeks, right? 70% of them are within 2 weeks of a worst day. We even saw a 2,000 down point day on Thursday, and we saw a 1,900 point up day on Friday. What new information is happening between those 2 days? None. Right, which is why I say this market is trading on sort of the behavioral elements and not so much on the fundamentals. And then, of course, 100% of these days were within 6 months. So you can't just sit it out for months saying, I'm going to wait for this to just wind down, because you'll miss those big rebound days that help you get back ahead. It's this sort of cartoon from my partner, Aldo here. He says, this is kind of funny that, somebody says, sell, I've got a stock here that could really excel. We can sell. It just gets exaggerated. And then somebody finally says, I can't take this anymore. Goodbye. And somebody hears buy, and all of a sudden it turns to buy, right? There's a herd mentality going either direction, and it moves swiftly, I guess would be the point. Another Q&A, how should we be positioned? Are there any opportunities to capitalize on? Well, one, let's talk about portfolios, and let's think about sort of just the way they're structured and sort of the hierarchy and sort of decisions. One, if I draw a line sort of right here, the bonds and the alternatives are the safety assets or the diversifying assets, and then the growth side is almost dominated here by equity, but includes some of these real assets. You know, we're in our natural process, and you saw this in a letter from me just at the beginning of last week. We're moving some money on the margin from this pot over to this pot, and that's just trying to buy stock via rebalancing. Some folks will call up and say, let's make a policy change. Let's say, look, instead of being 60% in stock, let's be 70% in stock. Let's move 10% from here to there. That's sort of an opportunistic trade. I don't generally recommend people go moving their policies around based on their market timing. I do like being a buyer here more than a seller here, you know, going this direction, because I think this just got cheaper, so I'd like to be buyers of it. But, you know, that's one thing you can do. Another thing people can do is, you know, you can put some excess savings to work. I say that in the same breath as telling you that liquidity is king right now, and make sure you got really adequate reserves. But if there's money that's been sitting there on the sideline that you've just been uncertain of, maybe it's not a bad time to get it to put to work if you really sort of take the long view on the global economy. You know, like I said, liquidity is king. One of the things that I'm really, when we talk in our investment committee, one of the things that I think is a lesson we learned in the financial crisis is beware of the dominoes. This is that, as I mentioned, there's the things that you can't see coming that get tripped up by some of these events that happen, right? You have a real estate crisis, houses are overpriced. Little do you know that all the mortgage debt is bad, and that all the mortgage debt is sitting on the bank's balance sheets, and then the banks suddenly have a crisis, and all of the corporate America is fearful that they're all going under, and everybody gets very conservative, and you have a massive global recession. So while some things might seem obvious, be careful. The one that stands out to me here is when I think about energy, right? Like oil is way down, or even airlines, perhaps. You know, there's a lot of debt out there. I think the biggest thing that concerns me is the amount of debt that's out there and how that exaggerates the business cycle. When things are good, it makes earnings look great. When things are bad, it makes earnings look really bad. And, you know, it wouldn't be out of the realm of thinking that, you know, perhaps some of these companies that are a little heavier leveraged and in greater debt maybe get into more trouble just simply because the business cycle gets exaggerated. I do think you buy value, especially those areas hit by the indiscriminate selling. You know, the indiscriminate selling really is, it has a logic behind it, clearly, the airlines, the cruise lines, the hospitality. You know, a lot of these things, and this is a good lesson when thinking about stocks, is, you know, when we think about what a stock's profits are going to be like, we don't think about what it's going to be like for the next, you know, 6 months. We think about what it will be for the next 4 or 5 years. How much money is it going to make? How's it going to grow profits over a long period of time? And to sort of throw an entire industry out because you think it's going to have 2 bad quarters of growth doesn't really seem to be taking the long view on a sector of the economy. Now, it's possible they get into just catastrophic trouble and they don't survive it, but I do think the federal government is probably a backstopper of some of these industries that could potentially get in more trouble because of this. Another thing, satellite-wise, that we're look at market leaders on sale, companies with economic moats, you know, that are somewhat sensitive to vagaries of the economy. I actually think the information technology sector, the IT sector, is kind of an example of this, where, you know, there's some big global brands that have real strong barriers to entry and economic moats that are now a lot cheaper than they were, and they're not, you know, they're not selling. They're not bars, they're not restaurants, they're not selling cruises. They're just businesses, like a lot of them, like I said, the software vendors and the technology vendors. So this is an interesting, you know, if you want to get into just some real numbers on where some of the real nasty results have been, you can see that this is year to date. That the S&P at this point was down 15%. It's now down closer to 25, I suppose. And the airline index, blue, is down about 38%, and the hotels, resorts, and cruise line sub-industry of the S&P is down almost 50%. If you look at like Royal Caribbean and American Airlines, I mean, the numbers are even worse. They're down 3/4. Although then they are starting to find some borrowing or some bottoming in there. But these are some of the things we're looking at. You know, maybe an airlines industry play, maybe an information technology play that has a little bit of an economic mode. I do think it's important to stay in the quality segments here. You know, clearly an airline is going to be sort of a flyer that has just been completely thrown out, maybe with the bathwater, but and that there's some federal backstopping if they're really getting into serious trouble. So, final thoughts. be personally safe and think of others, right? Not only keep yourself safe, but think of your neighbors, think about older folks that, if you're going to the store, maybe offer to pick some things up for them. And, a lot of younger folks I see are and be, oh, I'm unlikely to get really sick. But, the truth is that the more you're out there, the more this thing keeps moving around and it doesn't get shut down. So think of others and obviously be personally safe. Don't panic. The old line that Harold and Katz use quite a bit is you don't need your whole portfolio next month to buy groceries. You need it for many years. Even if you're 70, you could live, another 20 years, God willing. So it's not like you need all your money tomorrow. And so that's why, you don't want to panic. You still do have a long runway for markets to recover. This should be temporary. Life in the economy will return to normal in the future. You can't say when with certainty, but that's certainly the expectation that this should be a temporary event, even if it does sort of imprint on us forever and change behavior. And we were talking about sort of in Asia, how they're better equipped to handle these things. And lastly, I'll just say the more rational we are, the better decisions we make. So avoid, obviously, there's a tendency to let the fear of all this influence your decisions. And in some part, that's what we're here for. Is we bring a discipline to the process. We maybe separate from some of that emotion and do the things that are kind of tough to do. So the more rational we are, the better decisions we will make. And with that, I will say thank you. I appreciate you tuning in and hopefully find this was helpful. Please, we'll take any feedback that you may have and be safe. Thank you.